Talk to us about where you see excesses building up in the credit markets, if at all, right now.
Yeah, it's interesting. Despite the market remaining exceptionally actionable, particularly in the U.S. investment grade markets, the reality is we're actually down 10% on a gross supply basis year over year. Much of that a knock-on effect of tax reform and cash being repatriated. So you think about the top tech issuers in the market, the top 5 having $450 billion of cash based overseas that they've brought back on shore or have intentions of bringing back on shore. The reality is their need to issue in the investment grade markets has diminished, and or their ability to have strategic flexibility has increased simultaneously. So down 10% on a gross basis. That doesn't take into account the uptick in redemptions that we've seen this year. So record amount of cash naturally rotating back into investor hands. On a net supply basis, we're actually down closer to 40% year over year. So it's a real overwhelming sense of undersupply in the market right now. And so a fear of a buildup or that we've gone to the extreme in the other direction seems overstated in my view.
So when we talk about volatility in the markets, how much of that do you actually see in investment grade credit?
The real shift right now is not if investors are participating in the market, but where on the curve they're electing to play. So to me, the real friction as it stands now is a bifurcation and a tactical shift in terms of where on the curve are investors deploying their cash. And it falls into 2 camps. You think about some of the total return focused asset managers, some of the largest players in our market. They've had several years to extend out the curve. And the reality is there's been a shortening duration bias where they're playing in the 1 to 3 year part of the bucket, in some cases 3 to 5 years, because net total returns are actually, that's the only spot on the curve as we kicked off the month that was in positive territory. Those that are extending out the curve focused on total returns, you're down as much as 5% on the year, just as a function of the rate move we've seen higher.
Well, and are they also sort of looking at lower quality? I mean, that seems like it's what's happening in the high yield market. I mean, we take a look at the Bloomberg. We've got a chart here of high yield relative valuation. This is interesting. So this is the U.S. corporate high yield bond index, a ratio of that to just investment grade corporate bonds, and you see that at levels that we saw back in 97 and 2007. Is that any kind of signal for you that we're seeing some parallels, or no?
Yeah, on the investment grade side of the market, which is where I'm focused on origination, there's been an up in quality trade that you're seeing from the buy side. So a natural gravitation higher after a very M&A centric funding model, if you look at the course of the last several years. And so you are seeing a move from triple Bs, which had become a larger component of the market, as much as 50% from 35%, a year or so ago. The growth has come from triple B names, and I think what you're seeing is an up in quality move at a time where volatility is also increasing. So a real conflict in terms of a search for yield versus a search for quality.
And I'm glad you bring up the triple B names. Let's actually play you a soundbite from Eric Schatzker's interview with KKR's Jamie Weinstein. Oh, you know what? We don't have that. But in any case, he talks about the big explosion in the triple B market ex financials now versus where it was in prior cycles, and how it could be the seeds for the next crisis. I mean, this is going to be interesting because there's a risk of fallen angels when the credit rating agencies do start to move.
Yeah, it's an interesting thought. I think the reality is funding needs are coming down for most of the large corporate borrowers we're talking to. Tax reform has actually benefited and given them flexibility in terms of issuance. So the need to term out and to over leverage themselves and to have risk of downgrades feels pretty manageable from Barclays' vantage point. I think the reality is funding needs are gravitating lower, and so the willingness or the need to pay up and or to do outsized transactions that might put their investment grade ratings in peril, I think would be advised against. And in most cases, you're seeing issuers taking that more pragmatic route.